The question that we are going to practice in today's class is Pelta Company, and it is a past paper from September-December 2017 session. So let's start. Let's first see what is the requirement. Requirement A is calculate the NPV of the planned investment project. So you have to calculate the NPV of the project. Requirement two is of part A, calculate the discounted payback period. So you have to calculate the discounted payback period of the investment project as well. Discounted payback, you know how we calculate using that format of present value and then cumulative present value. Then in the part B, you have to discuss the financial acceptability of the investment project, which means you have to type this that whether you should go with the project or not. Okay. So let's see. Let's start the question. These are the part A is the calculation base which we will discuss in today's class. Okay, the calculations. So let's start. The directors of the Pelta company are considering the planned investment in the project costing 25 million and payable at the start of the first year of operation. The following information relates to the investment. So let's start. Part A and requirement one, which is you have to calculate the NPV. So the method, let's see the method, is it mentioned or not. So the details are given to you, then the inflation is given to you, the specific rate of inflation is given to you, that selling price is inflated by 4% per year, variable cost is inflated by 3% per year, fixed costs are incremental and related to the investment project are in nominal terms. Okay. So fixed cost is already in the nominal terms. So it includes the impact of inflation. So it means that for the other two things, selling price and variable cost, we have to inflate them. So it means we have to use basically NPV using NPV using nominal method or NPV. Wait a second. Requirement A. Again, nominal method and money method means the same thing, okay? NPV using nominal method. So let's start year one, two, year three, year four. We are doing the workings in dollar triple zero, so that's important. Control C, copy, shift, arrow, control V. Okay. Uh, well, I have to write year zero as well. So year zero, dollar triple zero, investment, which is 25 million. So 25,000. Okay, let me this. Okay, so then comes sales, revenue. So let's start calculating the sales revenue for year one. The sales volume was 520,000 units because we are doing the workings in triple zero. So I'm gonna write 520 multiply by selling price is 30, and you have to inflate the selling price by 4% each year. So I'm gonna multiply that with 1.04. So that is the sales revenue for year one. Let's move on to the year two. 624 times 30 times 1.04 power 2. So this is going to give me the sales revenue for year 2. Then year 3, 717 times 30 times 1.04 power 3. And then finally for the year 4, 788 times 30 times 1.04 power 4. So this will give me the sales revenue figure for each year. Then let's move on to the variable cost. So variable cost is gonna be is equal to negative because it's a cash outflow. So 520 is the units that you are selling. Variable cost per unit is 10 times variable cost you have to inflate by 3% per year. So multiply that with 1.03. 1.03. Then variable cost for year 2, again 624 times cost per unit is 10.2, and you have to inflate by 1.03 power 2. So it's gonna give you the variable cost for year two. Similarly, for year three, the sales unit are 717 variable. The second minus 717 variable cost per unit is 10.61 multiplied by 1.03 power 3. And for year four, 788 times 10.93 times 1.03 power 4. So 10.61, 10.2, 10, 1.03 power 2, 3, 4. Okay, so you got the variable cost. Now fixed cost, it is already in the nominal terms, which means that the impact of the inflation is already included in it. So you can just put the figure. So fixed cost is 700 for first year, 735 for second year, 779 for third year, and 841 for the fourth year. So this is gonna give you the taxable cash flows. Taxable cash flows. So I'm just gonna sum them, sum bracket, and this control C, and then copy paste control V. You got the taxable cash flows. Pelta company pays the corporation tax of 30% 1 year in arrears. So tax is paid at 30%, but it is in arrears, which means that the tax of year one is you will pay that in year two. Year two's tax will be paid in year three. Year three tax will be paid in year four, and year four tax will be paid in year five. So I will add one more section here in the years that will be five. Okay. So you can write years here as well. Years, just to show that these are the years. So let's do the working. So now, how will I do that? Look, is equal to minus tax is a cash outflow. I will take taxable cash flow of the first year, multiply that with 0.3. So basically, first year tax payment, I am showing that in the year two. Similarly, is equal to minus year two's tax. I will calculate that is 30, but I am showing the outflow at year three. Similarly, minus this times 0.3, and the year four tax payment will be shown in year five. So that's it. Okay. Then we have to calculate the tax savings as well. Tax savings. So tax written down allowance, you can write that as well. WDA. So working one, I have to do that here. Working number one of tax allowable depreciation. So years written down allowance and tax savings dollar triple zero control C, and here as well control V. So year one, year two, year three, year four. So your WDA written down allowance is 25% reducing balance method. So the investment is 25 million, 25,000 times 0.25. So now you can multiply this figure with 0.75 to get WDA for year 2, and similarly this figure multiply by 0.75 to get the WDA at year 3. Now for the last year, you know that we have to do the working of the balancing allowance or balancing charge. So let's do the working for balancing allowance and balancing charge. For that, we have to see whether there is any scrap value or not. So let's see. The view of the directors of the Pelta company are that all investment projects must be evaluated. Okay, okay. Here I missed few line. Okay. The year's four sales volume is expected to continue for foreseeable future. He's saying that the year's four sales volume, the 788,000, that is gonna be expected to be continued for foreseeable future. So it's indicates indication of the perpetuity cash flow. But here it's clearly mentioned that the view of the directors of the Pelta company are the project must be evaluated over 4 years of the operation with an assumed terminal value at the end of the fourth year of 5%. So there's a scrap value of the project as well, that is 5%, and we have to make a decision on the basis of the data that is given to us for the 4 years. Okay. So here there's a scrap value as well. So just let me write the scrap value here as well, which is 5% of the investment that I will get in year four. So is equal to, it is going to be cash inflow. So I'm just writing minus here so that negative will get positive times 5%, so 0.05. So that is gonna be my scrap value, and that's a cash inflow. Okay, now let's do the working for this last balancing allowance or balancing charge is equal to the initial investment that was 25,000 minus scrap value minus all of that. Wait a second. Easy way to do is investment that is 25,000 net of all WD already claimed. So these are the WD that are already claimed. This minus scrap value is going to be 1250. So now I'm going to calculate the tax savings is equal to this time the tax rate, to which is I think 30%. Yes, tax rate is 30%. So multiply by 3. So I can just do Control C, Control V. Just copy paste that. And this is going to give me the figures for my tax savings. Okay. Now let's put these figures in the format. So now, because tax payment is in arrears, the tax savings will also be shown accordingly. So year one's tax saving is gonna, you have to show that in year two. So I'm gonna show that in year two, year one savings. Look, I'm taking year one savings, but I'm showing them in year two. Similarly, year two savings you have to show in year three. Year three savings you have to show in year four, and year four saving you have to show in year five. So that's it. Now we can calculate the net cash flows. So the investment part, it's going to remain same, is equal to sum from this portion till this. Now, what is benefit of that? That I can just copy paste the formula. It will give me the answers. So that's these are the net cash flows figure. And now we have to calculate the discount factor. So discount at. So you are been given with the real after tax cost of capital and nominal as well. So obviously we have to use the nominal after tax cost of capital, that is 12%. So at 12% discount factors are for year 0, the discount factor is always 1. Then for year 1, discount factor at 12% is 0.893. 0.893, then 0.797, 0.712, 0.636, 0.567. So now you have to calculate the present values. Present values, let me drag down this. Present value will be this times discount at 12%. So just copy paste the formula, Control C, Shift, right arrow, drag till year 4 and press Control V to copy paste the formula. You got all the present values. Now you just need to sum them to get to calculate the NPV. So NPV would be is equal to sum of all these, which is going to give you the NPV of 10,484.65. So that is going to be your answer. Okay, so the question was very simple. You just need to be aware of the fact that because the tax payment is in arrears, so year one tax will be shown in year two in year three tax in year four tax in year five, and the savings as well. Okay, so that was the part one, uh, part A for this part one of the part A. Then comes second part in which you have to calculate the discounted payback. Discounted payback. Now, well, you should remember that for the discounted payback, I told you a format years, cash flow, discount factor, present value, cumulative present value, right? Now, because we already have the cash flows and discount factors and we already have the present value, so we can just shorten the format. So here I can just write years, present value and cumulative present value, right? Because I already know what the present value is. I don't need to draw the pro forma of, I don't need to add cash flow and discount factor here, because cash flow times discount factors answer present value is already given to us. And we have to compare PV, we have to look at the PV, right? And CPV to work out the answer. So for year zero, at year zero, there is always an investment. An investment is of how much? 25,000. So CPV will be 25,000. Okay. So it means that in year zero, you invested, your cash flow is negative 25,000 as per the present value. Then in year one, how much of the cash flow have you got? It's this 9080.94. So CPV will be, you can use this formula, that this plus this. So now your cash flow at the end of the year one is minus 15920. In year two, how much of the cash flow you are generating in the present value terms? 9233. Then again is equal to this plus this. So minus 6686.94. In year three, your cash inflow in the present value terms is 9029. So your CPV will be, okay. You got the positive answer. If you got the positive answer, it means that your payback is somewhere in between year two and year three, right? Okay. Remember one thing, that again enter this dollar triple zero as well here, okay? Because we are doing the workings in dollar triple zero, so you should add you should add it here as well. So control X, control V. Okay. Now your payback is somewhere in between year two or two year three, right? Because in year two the balance was negative, but at year three the balance is positive. So your payback is somewhere in between year two to year three. So I told you that you definitely know that it's 2 years. Then how many months or how many more is in a decimal? You don't know that. Okay. You don't know that how much more is in decimal. So the formula was very simple. I told you that you have to take previous year's CPV, which is 6666, this divided by this year's PV. This year PV means last PV, so you can divide it with this. So you got 0.74. So that is the decimal part. So now add 2 in that to get your answer. Okay. Add 2 in that to get your answer. Look, the concept is very simple. You know that it's somewhere in between 2 to 3 years. But how much is it if let's say you are doing this in the months? So 2 years, how many months, or in decimal, whether it is 2.4, 2.5, 2.6. So 2, you know. To calculate the other part, you need to use this formula which I told you in the class as well, that previous year's CPV divided by this year's PV. It's giving you 0.74, so it means the answer is 2.7. Now if you want to convert that into the months, you can just multiply that with 12. So this will give you 8.88, which is around 9 months. So your payback is around 2 years 9 months. Okay. So 2.74 or 9 months you can write. Okay. It's up to you. So what will you write here? Payback period, okay, in bold, B is equal to 2, plus the decimal portion. How did you calculate that? Because this is in negative and we are not concerned with the negative while calculating this decimal, so you can just write minus, so that negative negative will be positive, divided by this last year's PV. So you got your answer, payback period, which is 2.74, and just write years in front of that. Okay, years. So you can bold it in this way. So you got your payback, and that was for 2 marks. Okay. Now, in the last part, it's mentioned that the both NPV and discounted payback must be used. Uh, okay. Both net present value and discounted payback must be used with the maximum discounted payback period of the 2 years. So the targeted payback period of the company was 2 years, right? And your payback period of this project is 2.74. So it means that as per the payback period, you should not invest in the project, right? As per the payback period, you should not invest in the project because your targeted payback was 2 years. This project is taking 2.7 years to return your investment. But the NPV answer is positive 10,484. As per the NPV, you should go for the project. As per the NPV, you are earning from the project. As per the payback period, because you decision criteria for the payback period is that you have to compare the payback of the project with the company's targeted payback, which is 2 years in this question. So definitely on the basis of the payback period, you should not go for the project. Now there's a conflict between NPV and payback. So remember, when there is a conflict between NPV and payback, always you have to give preference to NPV method. You have to give preference to NPV method. And it's obvious. It's obvious this project is generating you 10,484 while we are doing the workings in triple zero, but this is generating you a significant amount of funds, right? Wealth. What is this NPV? NPV is basically the benefit or loss that you are getting from the project in present value terms. So you are getting a huge amount of the benefit in this project. So as per the NPV, you should go for the project, even if the discounted payback says that you should not go for the project. Okay. So that is what the part B was all about. Discuss the financial acceptability of the investment project. Now you have to write this on Word, but even if you had to, wrote it down, you could have simply write that the investment project is acceptable under the NPV decision rule, because the NPV is positive, okay, significantly positive. However, the discounted payback, as per the discounted payback period, because the targeted payback was 2 years and the project payback is 2.7 years. So from this perspective, the investment project is not acceptable. So in the last, you can give the conclusion that because as per the NPV is because as per the NPV method, you are getting a lot of benefit from this project, so you should go for the project, okay? And NPV should be given the preference. So that is what you have to write. For 3 marks, you will get the 3 marks as well. So we have done the question. These theoretical parts, that we are not doing. We will do that as well, but separately. But because right now we are in the class, we are learning how to do the calculation. So that is why my focus is more on the calculation parts of the past paper.